All right, so today I wanted to talk about another somewhat boring stock, but I think another stock that I think is very good, and I'll get into the reasons why. This is Old Dominion Freight Lines. Again, they are a transport company, basically. Let's just take a look exactly how they're described. Engages in the provision of less than truckload services. The company is headquartered in Thomasville, North Carolina. Currently employs 23,000 employees. Provides regional, interregional, and national services through a single integrated union-free organization. Offers expedited transportation, which is provided through a network of service centers located throughout the United States. Again, so you kind of get the idea. And there's a lot of reasons why I like this company. I mean, if you look at analysts, they don't predict a lot of upside. So that's one thing to keep in mind. And I think that's the reason. The reason is that we're expected to get a recession, which I think we're kind of already in. But so that's the reason why they're not overly bullish in the short term. But I think in the long term, this is a company that's going to do very well. And there's a lot of reasons for that. Again, they do pay a dividend. It is very small though, 0.41%. But the reason I like it is that they're growing it very, very fast. 35% compounded growth rate over the last 5 years. They did just start paying one in 2016. And again, they're growing that dividend very fast, which is one of the main reasons why I want to own this company. Again, do your own due diligence, all that kind of stuff. If we get into the financials here, fairly profitable company. I mean, very high gross margin, although free cash flow is not the greatest, but it has gotten better over time. Very strong return on equity, return on invested capital, which is a very good thing to see. If we look at free cash flow per share, it's grown very nicely. 2021 did come down a little from 2020. I'm sure the 2022 numbers are going to be out very soon. So I would be very interested to see those. If they're not the best, that would definitely make me a little less happy with things. But like I said, over the long run, I'm still pretty happy. Again, the balance sheet looks pretty good too. A current ratio of about 3 is very good. Again, that means that they do not have a lot of debt, which is always good to see. If we look at the cash flow, another very good thing I like to see here. They're buying back a lot of shares, right? In fact, they bought back a record amount of shares in 2021. Again, interested to see the 2022 numbers. But again, they're buying back, they're increasing the amount of share buybacks by a lot too. Like, I mean, look at these numbers. Again, 2018, 163 million, 2019, 241, 364 in 2020. Almost 600 in 2021. So that's very good to see. Again, free cash flow did come down a little bit in 2021, but it's still growing nicely. If this trend reverses, yeah, obviously that'll be concerning, but I think it's a blip on the radar. Again, if we get into the insights here, again, earnings are projected to go down slightly next year, or I guess that would be this year probably. But again, not something that's super concerning because they are growing very fast. Again, look at these growth numbers. Again, gross profit going up 22%, operating income 40%, net income 40%, operating cash flow 49%. Buying back shares, they have a very good current ratio. Again, so their balance sheet's looking really good. Very profitable. Again, look at these numbers here as well. Operating margin 28%, net margin 21%, free cash flow 16, cash conversion 75. Again, the returns are very, very nice. 37% return on equity last year. Very, very good there. This is a company that actually trades somewhat expensive too, which is something that is a little bit concerning for me. But it is very well below its 5-year averages. Again, price to free cash flow is 22% lower. Price to sales is actually slightly above, but still 5 is not that crazy. It has outperformed the S&P by a lot. So that's another very good thing to see. So again, this is a very good company in my opinion. If you do get a dip in this company over the next 6 months or whatever, in my opinion, I think it would be a very good buy. If you can get it in its 52-week low is 231. If you could get it below 250, I think that would be a screaming good deal. But where it stands now, I don't think it's even a terrible deal because it is well below its. I mean, let's just look at the metrics going back just to see exactly where it's been. Because, like I said, I know this is a company that has traded pretty expensive over the last 10 years or so. Let's just go back like, I don't know, 5, 6 years. Um, so again, its average price to free cash flow is 47. The lowest it's gotten is 27 over the last 6 years. So again, and it's at 32. So it's very close to its all-time low in price to free cash flow, right? Price to operating cash flow, it's definitely a little bit, it's actually a little bit above. But again, it has gotten as high as 37. So it's actually right above the average as far as price to operating cash flow goes. So again, like I said, I like these kind of companies because the 2010s and basically up until about a year ago was a decade to where these high-flying tech stocks were the place to be. And I think that there will still be some tech stocks that do good, but just blindly putting your money in tech was a very, very good trade, or I guess it's not really a trade, very good place to be over the last, basically coming out of '08, right? But I think that the next decade is going to be a little bit different in that rates probably don't get as low as they were, especially coming out of 2020, right? So it's going to be the businesses that are the best businesses that are going to do the best. The businesses that rely on cheap money to get by, i.e. a lot of these tech stocks. Again, like I said, I still think there's some good tech stocks. There is some companies that are fairly high value that will do well, but not as many, not nearly as many. And because of that, money will flow into these kinds of companies, right? The companies that actually provide the goods and services that we really need, right? Because again, trucking companies, yeah, they're going to be in high value because, well, many reasons, right? I mean, especially in North America, we have a rapidly growing population, right? And so again, stuff needs to get moved, right? Stuff needs to get moved. And how does it get moved? Well, it's typically trucking companies, right? So that's something that I think is going to be that's going to benefit these kinds of companies a lot. And again, the thing that just makes me fall in love with a lot of these companies, again, they're buying back shares and they're increasing that dividend really fast. Again, the way to find good companies is as simple as which companies are going to return the most value to me as an investor. And there's a lot of ways to figure that out, but one of the easiest ones is look at, hey, are they buying back shares? Are they increasing that dividend? Right? Because those are some of the easiest ways to tell. And those are the most obvious ways, right? And a company like this, that is exactly what they are doing. Again, this is a company that if you buy it today, 10 years from now, you'll have a dividend yield on, I mean, let's go back 10 years, right? You'll have a dividend yield on cost of 5%, right? And you bought it at like 0.5%, right? So that's what you want. 20 years from now, you'll have 15, 20%, right? That's exactly what I want in a company, right? I don't want a company that's overly speculative, that's like, yeah, we're going to, artificial intelligence is our big play, or any of these kind of plays, right? I want a company that I know that they're going to provide value, that they're providing value right now, and they're going to continue to provide that value into the future. Not, I think that it's going to provide value 10 years from now. No, I want one that's doing it right now, that has a proven track record and continues to get stuff done, right? Those are the companies, in my opinion, that you want to have your money in. Right? Obviously, again, my opinion, do your own research. Again, I'm just a guy on the internet, but this is what I want to see, right? And again, you want to, like, again, this is a company in the industrial sector, right? This is one of my favorite sectors because this is the sector that the best companies in the sector they're providing stuff we really need, right? Because at the end of the day, do we really need the latest AI tech? Not really, right? Especially in a higher rate environment, right? People are going to be more careful with how they spend their money, right? So again, you want to invest in the businesses that, number one, they make money in an easy way, right? We already know they're profitable, right? Like the easier and the more automated you can make things, the better, in my opinion, right? Because I don't need to guess, right? I mean, you take a company like Tesla, a lot of it is just a guess, right? I mean, we don't know for sure. I mean, they're the leader right now, but and again, like what if a lot of this AI self-driving stuff doesn't play out, right? You don't know, right? We don't know. And another big problem with that is a lot of that money, a lot of that is already priced into the stock, right? So again, I'm just giving an example there. But again, I like giving these examples because, again, I think that it's a really good company, an underrated company. And again, especially if we get a recession, you're going to be able to buy these companies at a discount. So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe, and stay tuned for more.